levels on an option chain. Options might seem complex at first, but they are just contracts that follow specific rules. Let's get started. Like and subscribe to IndexOrbit, and for best trading experience, use Dhan. For opening Demat account in Dhan app, use the referral code EJZZI9638. Let's start with the most basic question. What exactly is an option? Legally, an option is a financial derivative, but the most important word to remember is right. When you buy an option, you are buying the right to do something in the future, but you are not forced to do it. Think of it like booking a hotel room with a small non-refundable deposit. You have the right to show up and take the room at the agreed price, but if you change your mind and don't go, the hotel can't sue you to pay the full stay. You simply lose the small deposit. In the stock market, there are two main types of options: calls and puts. A call option gives you the right to buy an asset. You buy this if you think the price will go up. A put option gives you the right to sell an asset. Think of this like car insurance. You pay a premium to have the right to sell the damage of your car back to the insurance company at a fixed cost if an accident happens. You buy a put if you think the price will go down. Like and subscribe to IndexOrbit, and for best trading experience, use Dhan. For opening Demat account in Dhan app, use the referral code EJZZI96380. To understand how these contracts work, we need to look at the two sides of the trade, the buyer and the seller. In every option trade, there is a buyer, also known as the holder, and a seller, often called the writer. The buyer is the one who pays the money up front. Because they paid for the privilege, they have the right to decide if the contract is used. Their maximum loss is simply what they paid to enter the trade. On the other side, we have the seller. The seller receives that money immediately, but in exchange, they take on an obligation. Here we see the cash flowing from the buyer to the seller, and the obligation moving from the seller back to the buyer. If the buyer decides to exercise their right, the seller is legally forced to fulfill the contract, no matter how much it costs them. Think of it like this. The buyer is the person buying insurance, and the seller is the insurance company. The company takes your money, but they are obligated to pay out if you make a claim. Like and subscribe to IndexOrbit, and for best trading experience, use Dhan. For opening Demat account in Dhan app, use the referral code EJZZI96380. Now that we know what an option is, let's look at the three pillars of an option contract: strike price, premium, and expiry. First, the strike price. This is the pre-agreed price at which the buyer can buy or sell the stock. For example, if you buy a Nifty call option with a strike of 22,000, you have the right to buy Nifty at exactly 22,000. Next is the premium. This is the price you pay to own the option. It is not fixed. It changes every second based on market volatility, time left, and the price of the underlying asset. Think of it as the ticket price to enter the trade. Finally, we have expiry. Options don't last forever. They have a deadline. In the Indian market, specifically on the NSE, we have weekly and monthly expiries. Currently, Nifty weekly options expire every Thursday, while Bank Nifty weekly options expire every Wednesday. Monthly contracts for both expire on the last Thursday of the month. Once that clock hits the expiry time, the option either becomes valuable or turns into zero. Like and subscribe to IndexOrbit, and for best trading experience, use Dhan. For opening Demat account in Dhan app, use the referral code EJZZI96380. When trading options, you don't just buy one share at a time. You trade in bundles called lot sizes. As of the current NSE calendar, the lot size for Nifty 50 is 25 units. This means if the premium for a Nifty option is 100 rupees, the actual cost to buy one lot is 100 multiplied by 25, which equals 2,500 rupees. For Bank Nifty, the lot size is currently 15 units. It is important to always check the latest circulars from the National Stock Exchange, as these numbers are adjusted based on the index's price level to ensure retail traders can still participate. Remember, your profit and loss are also multiplied by this lot size. A 1-point move in the premium means a 25 rupee change in your P&L for a Nifty lot. Like and subscribe to IndexOrbit, and for the best trading experience, use Dhan. For opening a Demat account in the Dhan app, use the referral code EJZZI96380. Now we move to one of the most important concepts for any trader, moneyness. This describes the relationship between the strike price and the current market price, also known as the spot price. We categorize options into three states: in the money, at the money, and out of the money. Let's use an example. Imagine Nifty is currently trading at exactly 22,000. This is our spot price. If you look at the 22,000 strike, it is right where the market is. We call this at the money, or ATM. These options are very sensitive to price movements because the market is sitting right on the line. For a call option, in the money or ITM means the strike price is below the current spot price. For example, the 21,800 strike. You already have the right to buy cheaper than the market price. So this option has intrinsic value. Out of the money or OTM for a call means the strike is above the current spot price, like 22,200. Why would you pay to buy at 22,000? You wouldn't right now. These options have zero intrinsic value and rely entirely on the market moving up before expiry. Let's summarize this in a table. For calls, ITM is when the strike is less than the spot, ATM is equal, and OTM is when the strike is greater than the spot. For puts, it's the exact opposite. A put is in the money if the strike is higher than the spot, because you have the right to sell for more than the current market price. Like and subscribe to IndexOrbit, and for best trading experience, use Dhan. For opening Demat account in Dhan app, use the referral code EJZZI96380. To visualize this, traders use something called an option chain. It is a list of all available strike prices for a specific expiry. Take a look at this screenshot. Usually, the shaded areas represent the in-the-money options. Notice how the middle section, where the spot price sits, is the at-the-money zone. You will notice that out-of-the-money options are much cheaper than in-the-money ones. Why is that? It is because they have no intrinsic value. The price of an option, the premium, is made of two parts. Intrinsic value is the real value, how much the option is already worth if it expired right now. Time value is the hope value, the premium you pay for the possibility that the stock might move in your favor before time runs out. OTM options are 100% time value. If the market doesn't move past your strike price by the time of expiry, these options will go to zero. This is why they are considered lottery tickets. They are cheap to buy, but they have a very high probability of losing all their value. Understanding this split is the key to managing your risk. When you buy OTM, you are racing against the clock. Like and subscribe to IndexOrbit, and for best trading experience, use Dhan. For opening Demat account in Dhan app, use the referral code EJZZI96380. We have covered a lot of ground today. We started with the basic definition of an option as a right, not an obligation. We looked at the roles of buyers and sellers, and we broke down the three pillars: strike, premium, and expiry. Finally, we explored the option chain and learned why out-of-the-money options are cheaper, but carry higher risk due to the lack of intrinsic value. You should now feel comfortable reading an option chain and understanding what you are buying. In the next part, we will dive deeper into how these prices actually move. Thank you for watching. Make sure to like and subscribe to IndexOrbit for more trading education. For the best trading experience, we recommend using Dhan. To optimize and analyze your live trades, you can open a Demat account in the Dhan app using the referral code EJZZI96380. Happy trading!